This presentation is designed to give investors a clear, practical understanding of how these tax methods work, what to expect at year end, and when action is required versus when everything is handled automatically. We will go through the different tax methodologies depending on the funds you invest in, the key dates to remember, and finally, we will look through some commonly asked questions. This webinar is for informational purposes only for New Zealand tax residents. We are not tax advisors, and if you do need tax advice, we strongly recommend that you seek independent expert advice. With that being said, let's kick off by taking a look at the 4 different tax methodologies that are applied, depending on the investments that you have through InvestNow. New Zealand taxes investment income differently, depending on the legal and tax structure of the investment, rather than simply the type of asset held. For retail investors using platforms such as InvestNow, the most common tax treatments fall into 4 broad categories: multi-rate portfolio investment entities, or PIEs, listed PIEs, term deposits subject to resident withholding tax, or RWT, and offshore investments subject to the Foreign Investment Fund, or FIF rules. Understanding which category your investment falls into is critical because it determines whether tax is paid automatically on your behalf, whether it is final, and whether you need to take action at tax return time. Multi-rate PIEs, including most unlisted managed funds and KiwiSaver funds, are designed to simplify tax for investors by calculating and paying tax at each investor's prescribed investor rate. This is capped at 28%. For most individuals, this tax is final and does not need to be included in an IR3 return. Listed PIEs, such as many smart ETFs, are structured differently. They pay tax at a fixed company rate of 28% and distribute dividends with imputation credits attached. Investors can usually choose whether to include those dividends in their tax return, which can create opportunities for refunds if their personal tax rate is lower than 28%. Term deposits are taxed through RWT and are deducted when interest is paid, and may need reconciling if the chosen RWT rate does not match the investor's marginal tax rate. Finally, offshore investments like Australian Unit Trusts, or AUTs, are typically taxed under the FIF regime, which uses deemed or comparative income calculations rather than actual cash received. The first methodology, PIE tax. PIE tax applies to all multi-rate PIE funds and all funds in the InvestNow KiwiSaver scheme. PIE tax is deducted in 2 instances: at the end of the financial year, more on that in the coming slides, or when you sell units in a fund. PIE tax is not directly related to the change in value of your investment or the distributions you receive from your investments. Distributions paid out by PIE funds are not taxed. The PIE fund attributes its income or loss from its investments, expenses, and tax credits every day. The net taxable income and tax credits are divided among all units of the fund, and a share of income and credits is attributed to everyone investing in the fund. Your PIE tax obligation is calculated using your prescribed investor rate, or PIR. Your PIR is based on your taxable income in the last 2 income years. So for example, income from salary, wages, and any additional sources of income that you may include in your income tax return. PIR rates for individuals include 10.5%, 17.5%, and 28%. Companies should use 0%, and trusts can choose either 0%, 10.5%, 17.5%, or 28%. As we calculate and pay your PIE tax to the IRD at the end of the financial year, there is nothing you need to do when it comes to a tax return. Your PIE tax information will display in your MyIR in May or June, and will be shown under our custodian, Adminis Custodial Nominees Limited. If you have both a managed funds and KiwiSaver account with InvestNow, you will see 2 separate lines in your MyIR. You will receive a tax report at the end of the financial year, which you can use to reconcile with the figures shown there. For those investors who invest through a trust or a company with a PIR of 0%, we provide the gross taxable income in your tax report to include in your tax return. Listed PIE tax. The second methodology is only applied to smart exchange-traded funds, or ETFs, on the InvestNow platform. A listed PIE fund is taxed like a company, with tax deducted at 28% from all dividends you receive from smart funds. The dividends may include tax credits, known as imputation credits, which are credits for New Zealand tax already paid by the companies the ETF is invested in. This is to ensure that income isn't taxed twice. While you are not required to include listed PI dividends and related imputation credits in your income tax return, you can include the taxable or imputed portion if you prefer. Including the dividends may be beneficial if your income tax rate is less than 28%, as this will result in excess imputation credits that can be used to reduce the tax payable on your other income. All the relevant information is provided in our tax report for you to complete this on your tax return. Australian unit trusts. The third methodology applies to Australian unit trust funds, or AUTs. AUTs are considered foreign investment funds, and the income from AUTs are subject to Foreign Investment Fund or FIF rules. We don't deduct any tax on your behalf from these investments, with all relevant information included in your tax report provided at the end of the financial year. You will need to include this information in your tax return. There are 3 different options that you can include in your tax return depending on the funds you have invested. The first of these is the de minimis exemption, and it only applies if your total cost of your FIF investments did not exceed 50,000 New Zealand dollars at any point during the income year. The total cost of your FIF investments represents all your applications or buy orders and any dividend reinvestment, but excludes any capital gains, losses, or market movements. So for example, if you only invested 40,000 New Zealand dollars into an AUT that has since appreciated to $60,000, you would be under the $50,000 threshold and be eligible for the de minimis exemption. The $50,000 threshold is across all your investments into foreign investment funds, whether held on InvestNow or otherwise, and includes all AUTs as well as investments like direct shareholdings and offshore ETFs. If the de minimis exemption applies, the FIF income you declare in your tax return is limited to the value of the distributions received from your FIF investments, which you then pay tax on at your marginal tax rate, which can be up to 39%. If the distributions from your FIF investments plus any untaxed income like rental or self-employed income is less than $200, you don't need to declare this FIF income and your FIF taxes are all sorted. If you qualify under the de minimis exemption, you can still choose to calculate your income using one of the standard non-de minimis exemption FIF calculation methods. However, if you do elect to do this, you must apply one of those standard FIF income calculation methods for the next 4 years. If the cost basis of your FIF investments are greater than $50,000, then you won't be eligible for the de minimis exemption, and you must calculate your FIF income using one of the FIF income calculation methods. There are 2 main calculations to be aware of. The fair dividend rate, or FDR method. This calculates your FIF income as 5% of the opening market value at the beginning of the income year, plus a quick sale adjustment if you bought and then subsequently sold units in the same fund during the year. The second method is the comparative value, or CV method. This calculates your FIF income using the closing value plus gains, minusing the opening value plus costs. Gains include dividends, sale proceeds, and tax credits. Costs include the cost of buying units along with foreign income tax paid by you directly on income of the FIF. We provide the dividend amount along with the above 2 calculations in your tax report, which is used to complete your tax return. Note that the choice of your FDR or CV method must be applied to all foreign investment funds, whether held on InvestNow or otherwise. So it is important to ensure you choose the method that best suits your entire portfolio of foreign investment funds, as you cannot choose one method for what you invest in through InvestNow and another for something you might hold with another provider. There are also foreign tax credits. Foreign tax credits may be applied to your investments. Australian withholding tax may have been deducted on dividends received from your AUT holdings. You may be able to claim this as a credit against your New Zealand income tax liability. However, there are certain limits that apply. The credit available in relation to tax withheld from a specific fund cannot exceed your New Zealand tax liability on that fund for the relevant year. If you did not receive any FIF income from a particular fund, you will not be able to claim that foreign tax credit. The last methodology, resident withholding tax. This is only applicable to term deposit investments through InvestNow, and we pay this directly to the IRD. You will only pay RWT when you receive interest from your term deposit during the financial year. Now that we've covered those four methodologies, let's work through what practically happens during the tax period. As you can see, here is the 2026 timetable. The first email you will receive is the PI tax estimate for the 2026 financial year. This is simply to give you an idea of how much PI tax you may be paying. We offer two options to cover your managed funds account PI tax obligations. You can either deposit funds to your Invest Now transaction account, or we will sell units of the highest PI holding on your behalf to cover your tax obligation. You can find the deposit details under the dashboard tab when you are logged into your Invest Now account, and you will need to make the deposit from your nominated bank account. This first email is a great heads up if you are looking to take that deposit in cash option to cover your PI tax obligation. For KiwiSaver account holders, you will not receive this email as we do not offer the deposit cash option, and we will automatically sell units of the highest holding on the 16th of April. For those that are invested in the Foundation Series PI ETF funds across both managed funds and our KiwiSaver scheme, the transaction fee is not charged to sell units to cover your PI tax obligation. The second email you will receive is the final PI tax obligation email. This is the final amount that is being deducted from your Invest Now account, and this amount will be slightly different as we have the final unit prices for all the funds along with the last few days of March PI tax obligation. This email will show you the PI tax obligation and the amount you still need to deposit to your Invest Now transaction account. A quick tip, if you are seeing $0 in that amount owing column, there is enough cash available in your Invest Now transaction account to cover your tax obligation, and there is nothing more that you need to do. Highlighted in red here are the days you must deposit cash if you are looking to take that option and not have units sold. After this point, we will sell units to cover your PI tax obligation. Funds need to be available in your Invest Now transaction account by 5 p.m. Wednesday, the 15th of April. My suggestion, make that deposit on the morning of Wednesday, the 15th of April at the very latest. After this point, as stated, we will sell units from your highest PI holding to cover your PI tax obligation. The last two parts of the timetable are about tax reports. In mid-May, the annual tax reports will be made available to customers, with the annual member statements being made available to Invest Now KiwiSaver scheme members at the start of June. In both instances, we send an email confirming that these are available under the Documents page when you are logged into your Invest Now account. Bringing all of this together is the tax report you will receive as a customer. For those of you who have already been through tax time with us, you will notice that this report is different from previous years. The first page of the report will show information regarding your term deposit and fifth income for the financial year. You will find the term deposit interest payments information under the New Zealand income section of the report. You will only see information here if you have received an interest payment during the financial year. This information is automatically reported to the IRD, but if you do want to update the figures manually, you can do so under the interest income section of your tax return. Your fifth income is shown in two places on this first page. You will find the dividend information, so the de minimis exemption applies, in the overseas income section under dividends. You will also see the foreign tax credit information. The FDR and CV calculations are shown in the bottom left-hand table under foreign investment income. When completing your tax return, you will enter these numbers under the overseas income section of the tax return. That foreign tax credit number can be used regardless of whether you fall under the de minimis exemption or not. There are a few key things to note here when you're completing this section of your tax return. The jurisdiction will always be Australia, and for the income type, you will select whether you're entering the dividends amount or fifth income if you are using either the CV or FDR method. Page 2 of the report is all about your PI income for the year from both multi-rate and listed PI investments. Information included under the PI income sections of the report is automatically reported to the IRD. The listed PI distributions section shows all the relevant information for the tax deducted from your smart investments. If you do want to enter this in your tax return, this can be entered under the New Zealand dividend section of your tax return. You will need both the gross dividends and total dividend imputation credit numbers to do this. The final pages of the report will provide a summary of your account, showing the value at both the beginning and the end of the tax year. It will also show the transactions on your account during the year. For those that use an accountant for their tax return each year, this is the section of the report. This section of the report is what they will be looking for when they ask for the closing and end valuations for the year. The tax report will be in PDF format for all customers. However, if you do need an Excel file, you can contact the InvestNow customer service team to provide you one. Finally, here are some common questions we receive at tax time. What if the wrong PIR has been applied to my account? Once your PITax information is provided to the IRD, they will calculate whether the right PIR has been used and the right amount of tax has been deducted. If the wrong PITax has been paid, the IRD will calculate the difference and add or subtract this from your total tax for the year. The IRD will contact you directly if you're receiving a tax rebate or have tax to pay, which usually happens in May. What happens if I have a regular investment plan during tax time? As we reserve funds for PITax, this can mean that your regular investment plan may fail to run. You will receive an email confirming that your plan has not run, and we will contact customers in the last week of April where plans may have stopped due to a PITax payment. We do try and run your plan 3 times before stopping the plan. The simplest way to resolve this is to log into your account and to deposit funds to make sure your plan runs. Can I get a PITax refund? You absolutely can get a PITax refund. We will email you confirming that you received one for the 2026 financial year, and the rebate will be paid to your InvestNow transaction account. How is PITax calculated on a joint account? For joint accounts, we calculate and pay PITax based on the IRD number and tax rates held at the account level. Where we have an IRD number for each member on the joint account, the IRD will automatically split the PI income equally, so 50-50, between each member. If you wish, you can manually adjust the split in MyIR. That wraps up our tax webinar for 2026. Thank you for taking the time to join us today, and I hope this webinar has given you confidence in what to expect at tax time. If you have any questions, please don't hesitate to contact the team at contact@investnow.co.nz through the little chat icon on our website, or give us a call on 0800 499 466. Thank you very much.